full-fledged one for you. So make yourself comfortable, pen and paper. You'll also want a photo camera. So I say welcome one and all, and we're going to get going very soon as well. Just make yourselves all comfortable, and we are ready to go. Let me know that you can see and hear me loud and clear. Also, let me know where you're from. David, Plymouth. I was quick off the mark. So I want to share the screen with you because I've got a lot of slides, lots of information on the markets to share with you as well. So we're going to go straight into it. Remember, this is for educational purposes. It's not a solicitation to buy or sell any individual stock. It's not individual financial advice because I'm not speaking to you individually. I'm speaking to you collectively. What we're going to go through is the stock market and the opportunities at the moment for a sensible pension portfolio, not trading in and out, not noise. So I will answer all your questions around all of that. I will also, during the course of this webinar, take you through this, why I think we've got room to grow, where that growth is going to come from. And we're also going to go through, just so you know, all the things that we're going to go through in this webinar. We'll go through the latest news, what's going on. We'll go through the various sectors in the markets as well. Going to have a look at the S&P 500, where we are on that. We'll look at UK markets as well. We'll look at individual stocks such as Microsoft. We'll look at why fund managers are so rubbish, like Fundsmith, and how we've managed to sort of drill down in their maths and show that their performance is so poor. So, as I say, look at individual stocks as well. In that, and then we'll show you some free tools that we have on the website, free pension calculators for you right at the end. And then finally, in the Q&A section, you'll be able to connect with me on LinkedIn and see more of what I do, who I am, as well, and ask questions there as well. So for now, let's get on with it all and just give you an overview before we start diving into the markets, what it is that we're going to cover. So my whole approach is based on the scientific approach. We look at a hypothesis such as how do we decide which stocks are more likely to go up than others? And the work of people such as Eugene Fama, Daniel Kahneman, Nobel Prize winners, we use. The end goal is peace of mind. When you're holding investments, it's peace of mind. It's not to compare yourself to your neighbors or the S&P or anything else, though most people like to compare it to the S&P, so be it. It's really, are we hitting the targets for the kind of money we want to make? Now, if I want to double my money in 2.5 to 5 years, if there's a tailwind in 2.5 years, if there's not a tailwind and there's a fall like 2022, maybe it takes 5 years, then what do I need to do that? And what I'll talk about later is how do we filter 10,000 companies so that we're looking at the companies which are undervalued because we know they do better than overvalued companies, then ones which are also growing of those because growing companies tend to do better than ones which aren't, and then ones which have high cash return on capital invested. The reason we look at P&L, balance sheet, and cash flow statements is because all companies have those. And that way we can look at British companies, European companies, US companies, Chinese companies, Indian companies, and Korean companies, Taiwanese companies, and then narrow those down to say, right, which ones are not likely to make mistakes, okay? And then once you've got your 20 to 40 stocks, so 5% to 2.5% in each, you leave it well alone and rebalance annually. So it's made very simple to avoid panic and boredom. That's it. That's what we're going to talk about in all of this. Stockholm is covered. Hello, is this one live? Yes, Daniel, and you can do Q&A as well. Hearing all good. Fantastic. Aylesbury, sunny. Ilminster, great. We've got Cardiff, sunny Spain. Jeffrey, that must be you as well. Dubai, Anuj, hello, my friend. Welcome. So let me give you before we do a deep dive into the market for the year ahead, let's give you the overview. There's a lot of news going on, of course, with interest rates, with Trump, with tariffs, with the Supreme Court, with war in the Middle East, war in Europe, and so on. So before we go into the market news, which I'll cover just some of the companies and what's going on and what does all of these things mean and so on, what I want to do is just give you the overview. So the overview is this, and we're getting the same soundings from JP Morgan Private Bank, Goldman Sachs Wealth Management, Morgan Stanley. They're all coming, it's almost as if they all hire the same people, is that we do see this persisting into 2026. However, What I expect to happen is a 14% drop at some point in the S&P, which is what's going to cause a lot of people to panic, doubt themselves, and get wrong-footed. And the classic example I give people is Microsoft in 2021, where it went up 50%. But because for 9 of those 12 months it was falling or flat, people either panicked or got bored and didn't make 50%. It's that simple. Okay, so what's going to happen this year is a lot of people aren't going to make money, not because the markets are falling, but because they're going to panic when it does fall. And because for probably 6 of those 12 months, if you aggregate those months together, it'll give you a 0% return. They're going to get bored and they're going to chase trends. So it's really the year of avoiding cock-ups, okay? Because actually quality companies are going to continue profiting and doing well. So let's break that down into what that all means, and so I can answer your questions before you ask them. The core drivers. The most important thing, which you might not be aware of, is that if interest rates are not rising or not indicated by the central banks in the UK and the US obviously in particular, to rise, if they're not indicated to rise, then the markets will continue going up. So 2018, final quarter, final 3 months, there was a tightening cycle at the Federal Reserve. Similarly in 2022, stock markets fell. Now that is what is determining everything at the moment. Now you might think, what the hell? You mean the UK markets are going to be dependent upon what the Fed do? Well, if the US markets fall, everything else gets correlated to the downside. Okay. Now we're not seeing any signs of that at the moment with the Fed. And actually we want we want more jobless numbers. We want more people to be unemployed in the US. So they're less likely to raise interest rates, which is better for our stock market. Okay. Our stock market investments. And as goes the US, so goes the UK. And I'll talk about the UK in a second. Now, what you're probably thinking at the moment is, yeah, but what about sectors? What about this stock? What about that? You've been programmed into gambling by brokers, by magazine vendors, and you've been programmed into thinking if you chase the next hot tip and you can time it perfectly, and if you pick the next cycle or the next country or the next theme or the next narrative or the next story, what nobody's ever bothered to tell you is, wait a minute, surely data is more important than narratives, which is why we look at data and we say, well, wait a minute, we don't care which sector something's in. Is it making money? Now, these don't meet our criteria. I'm showing you how strict your criteria have to be because they don't meet value, growth, income, cash flow, Sortino. They don't meet all of those criteria. Okay. And the reason I'm making that point to you is because you've been addicted and told by people who have a conflict of interest with you because they want to sell you a newsletter or a magazine or a brokerage commission through making you trade or buy a fund by saying that they're so clever, is that you've been led to believe that if they say to you, hey, buy Green Dot, well, wait a minute, even Warren Buffett didn't get every single stock in his portfolio up every single year. So surely we should be looking at portfolios, not just individual stocks. Of course, we expect 20 stocks in our portfolio, let's say, to all go up, but they're not likely to, because even the greatest investor in the world didn't do that, which gives you a clue that you're not going to. So we should be looking at portfolio level. So I'm going to show you that once you put a portfolio, when you think at portfolio level instead of individual stock level, you're less likely to panic that a certain stock has dropped. So all your psychological biases towards panicking that every stock didn't go up and it didn't all go up double digit or something's fallen 30%. So therefore you panic and exit right at the bottom and you try and time it and you mess up even a 50% return year. Those are the mistakes I've got to deprogram you from. Those are the ones which are happening a lot now because of the amount and volume of volatile noise and news we're getting. Okay, so we're going to focus on deprogramming you from a lot of this negative news, right? So the good news, which is out of our hands, is there is a tailwind in that they're not raising interest rates. There's also, you might not know this, $170 billion fiscal stimulus out of Donald Trump's big, beautiful bill, we can literally call that, okay? The big, beautiful spend bill, which is what Elon Musk got so pissed off about and fell out with Trump over. He said, you're increasing the federal deficit by spending more through tax breaks. There's only two types of ways a government injects money into the economy: monetary policy, fiscal. Monetary is basically just think of interest rates, although there is quantitative easing, but don't worry about it. It's not going on at the moment. Monetary is interest rates through the Federal Reserve, okay, which is independent of government anyway, or tax, fiscal policy, i.e. you can spend or you can tax. Tax less, tax more, So you've got more money in your pockets. And there are only three components to the economy. There's the consumer, there's the investor, i.e. companies, and there's government. Okay? So of those, I mean, it's a bit more complicated than that, but essentially there's only three elements. Okay? And of those three elements, if they've got more money, then the economy does well, right? It's as simple as that, obviously. But we work on expectations. We think chess moves, what's going to happen next and what's going to happen after. Well, at the moment, the beautiful thing about what Donald Trump's done, either by design, either the man's an absolute freaking genius in economics, or he's accidentally stumbled onto something through gut feel, which I think is more like that. Because by increasing tariffs, he's up taxes, but by reducing fiscal tightening, i.e. by spending more, he's countered that, he's balanced it out. And by pushing for lower interest rates, he's also cancelled it out. So he's been able to tariff the hell out of people and claim it's a big stick without causing economic damage. It's beautiful. It's Goldilocks. Okay. It's not too hot, not too cold, the economy. And it looks like, according to Morgan Stanley and others, not just me, the fourth year is going to continue rising. Okay. Now, in the noise you're going to hear about is going to be about AI. You're going to hear a lot of noise that, oh, AI spending too much. How can they ever get those returns? Well, actually, when you look at the valuations of something like NVIDIA, you're paying about $30 for every future dollar of profits. That's pretty similar to what you've always historically paid for tech companies. In fact, it's cheaper than you've historically paid for them. And it's nowhere near how much you're paying for Tesla. So it's like renting a property and somebody saying, well, it produces a rent of $1 a year, and you say, I'll pay $30 for it. Is it too much? Is it too little? Well, depends what everything else in the neighborhood's going for. If it's going for $20 everywhere else, you've paid too much. If it's going for $50 everywhere else, hey, guess what? You've got a bargain and you could flip it and sell it at 50, for instance. That's what valuation is. And the beauty at the moment of what's going on is when you look at the data, as opposed to the narrative and the panicking journalists, who I'll show you in a second, we're doing all right on that side of things as well. Okay. So the AI productivity thing, long term, a bit like electricity and light bulbs, we know we're fine. Short term, you're going to get noise. That noise is there to cause you panic and stop you making money. People like me are not going to get panicked. We're not going to get bored because we've got the experience. So we're going to get wealthier out of the very same place that you have access to, the market. Okay. And it's going to come down to not us knowing more. Well, we know more about not panicking. It's not about us knowing more about the companies. It's going to be about us knowing more about not panicking, not getting bored. Okay. Similarly, there's the midterm elections in November. Now, generally, that means before November, lots of volatility. So remember that 14% drop. It's going to happen. You're going to relax. There's only three things you can do when the market drops. You can either buy more, but you might get overexposed, overconcentrated. So most people won't do that. You can sell in the hope of buying back cheaper later. Well, that's what traders do. You're unlikely to be a good trader. Just life. Your brain will get in the way. Or you could just hold through it, which is what most private investors should probably do, which makes life a lot easier because you see all this noise and people screaming and you go, yeah, I can be very British about this. I'll just keep calm and carry on. That's going to be the default position this year, almost certainly, as opposed to let's trade in and out. Because it's clearly with this volatility, I wouldn't want somebody to think they're going to be a trader. So what's happening in terms of money flow? Yes, there is money going into the UK because it's not the US, and it's UK's oil and mining and banking. Okay. It's got its niche. It's found it at last. And therefore the FTSE 100 is going up as a result out of diversification. We're not buying into it because we're trading or we're timing. We'll have at most 5%. Same with gold, 5%. Same with Japan ETF, 5%. Okay. Because you've got to think to yourself, am I in or am I out? If I'm in gold, then I don't care whether it's going to crash or not. Am I in or not? If I'm in, then I've got to be in for a long period of time. And if I'm going to be in for a long period of time as an investment, then I only want 5% anyway. If you want to, everything else is trading, and that's what people want you to do. Oh, Alpesh, I heard gold could go double. Well, yeah, if you want to have a punt on that, go to Ladbrokes, but not with your pension. So everything gets handcuffed in your pension by, well, if it's longer term and I should not have more than 5% in any one thing, then that's simplified my decision making, hasn't it? Then I don't care whether or not it's going to double because I'm not trading it. And if I want to trade it, that's something else. I'll go watch another webinar. Okay. Emerging markets, I'll come across India and stuff in a moment. People say to me, oh, how can I get access to that? Now, here are some themes. And so far this year to date, these are the big themes. Now, I'm going to show you something, okay? What you can see there, you should be able to see that fairly clearly. Sorry if it's a bit blurred. Okay, so you might say, oh, memory is the big theme, okay? Micron, memory company, which we happen to hold. But listen to this really carefully. Did we know it was going to go up 31% year to date? No. If we knew that, we would have put everything in Micron and said, this is the only one you want. Why did we have it? Because it hit value, growth, income. How much have you got in it? 5% of our portfolio, actually slightly less than 5% in there, because we've got about 40 stocks in the quality 5+. Okay. So the point is, had we known it was going to go up that much, we would have put more in. Anybody who tells you, oh, this is going to go really up, or really confident, they're lying to you. How do you know they're lying to you? Well, surely if they really thought it was going to go up as much as they claim to do on TV, they would put all their money in and mortgage their house on it. So what they really should be saying is, I don't know, and you should be looking at the portfolio. That's why it's in my portfolio, but I look at it not individually and kick myself that I didn't have more. And Micron's not the only one. You've got Western Digital's in there. Okay, that's up 57%. Now, why am I kicking myself? It's part of a model portfolio where it's got less than 5% in there, because we first of all had to have a portfolio. Otherwise, it'd have single stock risk. So when we look at these, and you might say, well, wait a minute, Alpesh, I heard a lot about foundries. You know, Intel's up 32% so far this year. And then, or Taiwan Semiconductor, which is also in the foundry business, is only up 18. But look at that. Look at those differences. So how do you pick between them? You can only pick by looking at the portfolio level and looking at, do they tick the value, growth, income, and what's their volatility? More importantly, what's the volatility of the portfolio as a whole? So I'll show you some models later on how, in a model portfolio, we've got to make sure that we're not taking too much downside risk. To give you a classic example of what I mean, I don't want more than 5% Bitcoin because it's too volatile. There, you understand what I'm saying now, don't you? Now, are there going to be some great themes? Yes, but we don't trade and invest on themes and the latest story. So if you look at something like uranium, okay, you look at uranium, and you look at some of the biggest movers in uranium so far this year. UEC is one ticker symbol. Okay, UEC is a company which has gone up 45%. And you think to yourself, oh, wow, well, some of these are penny stocks. They're ultra high risk. And if you're going to go like the magazine articles in the newspapers and the Motley Fools want you to, uranium's the next big thing. Sector's up 30% this year. Why didn't you go into, for instance, let me give you one, NXE. Okay. Well, it's at $11. And if that drops a little bit, you're screwed, even though it's up 26%. Now, if you want to do that for fun, be my guest. Feel free. Okay. Nobody ever talks about bloody packaging, do they? Nobody ever talks about how ASX is up 37%, or Form, FORM, is up 68%, because packaging is bloody boring. So the other point I want to make to you is, we don't care what the company does. I mean, it's semiconductor packaging, but the word packaging sounds pretty bloody boring. Okay. We care about, are they ticking the boxes? Now, correlation. You might say, well, hang on, Alpesh, surely we don't want everything only in semiconductors. You're right. When we put it into a model portfolio, we want to make sure everything doesn't move in lockstep and everything fall at the same time. But that's not done by saying, oh, well, I've got semiconductors, I'll put some in fintech, because they must be uncorrelated. You actually put them in a model portfolio, you put them in a portfolio, and you then look at it accordingly. Okay, and here's another thing that you really need to know. What happened to cloud computing? Surely cloud computing is still a big thing. Of course it is. Well, just because they've fallen for a short while, because everybody wrote a story about how software as a service, software companies are going to die because of AI. Is that noise, or is it just the regular falls? I mean, Warren Buffett, before he became the world's richest man, 3 times his company fell 50%, yet he became the world's richest man. So all this narrative and noise is there to fool you into thinking, and it's tempting. Oh, but I should be in missile companies, okay? I should be in missiles and long-range weapons companies like LMT, which is up 30%. Well, wait a minute. Have you looked at whether or not that's a good company? Have you looked at value, growth, income, and where does it sit overall in a portfolio? Okay, is it as good as others that you could have instead? And then rare earth catches everybody's eyes. But there's very few which aren't particularly volatile. I mean, if you look at USAR, that's incredibly volatile, even though it's up 100%. So you think, oh, well, that's all right, but I'm here to have a punt. Well, if you are, please don't do it with your pension. Go and have a punt. But if you're going to have a punt, you can't be putting too much money in, because it's a punt. In which case, it's like putting your foot on the brake and the accelerator. So you don't want USAR, even though it's gone up 100%. because you wouldn't put too much money in it because it's only a penny stock at $23. Yet it's a rare earth company. Which ones have smooth upward moves? Well, what if I told you that LXFR does in rare earths, but it's only up 15%? Then you say, oh, it's smooth. It's not risky. It's not volatile, but it's barely moved. So do you want volatility? Do you want the high risk movements? Well, possibly not. So do you see how you're already being constrained? It's not about the next big thing and the narrative and the story and the headline, because I've given you a load of names which have gone up incredibly well, which might continue going up, but there's very good reasons not to have them in a pension. Volatility being one of them, the speculative nature of them being another, the low price point and the penny sharedness of them, and the fact that they could easily collapse because they're not good value growth income companies. So you're gambling and taking a punt, so you put less money in, so you might as well have not put any in at all. Do you see the constraints you've got? So getting wealthy from investing, therefore, must be that you have a portfolio for the long term that you leave alone. It can't be that you punt in and out, which you can if you try and want to, but go to Vegas, because that's the best place to punt in and out. Okay, right? So I just wanted to make that point on themes you're going to hear a lot of and all the noise. This year, you're going to be stopped from making money because of the negative news coming out and the volatile news coming out of the markets, okay? Not because there aren't good companies out there, right? So it's going to come down to approach and not panicking. Okay, Alpesh, let's look at what's in the news then. Let's look at what's going on. Is there something we should be worried about? Well, I don't particularly care about Epstein. He's pretty much met everybody on the bloody planet. I'm sure the Pope's been plumbing there by now. You know, you're a nobody. Sadly, I'm not even in his list. It means I must be a nobody. China's Alibaba launches AI model to power up robots. Okay, giant. Now, you're going to hear a lot of stories to scare you that China are going to outcompete and outbeat. When you buy a stock, let's say it's Microsoft, the reason Warren Buffett said it's as if you own the business, is because it's not for you to try and work out if the Chinese are going to outsmart Microsoft. Thank you very much for your brain power, but we really don't need your help. Microsoft will try and work out how to make money because they've got good enough people. So thank you for bringing your ego to the table and thinking it's your job to work out how to answer China. It's not. It's theirs. That's why you bought shares in them. Okay. Now, why don't I, to get exposure to China, have Alibaba? It's a bit volatile. It tends to drop quite sharply. So it's not one that I particularly like having for China, but I know others do. And I have no doubt that as a long-term China play, it would do rather well. I have no doubt it will do rather well. If I wanted to have a deeper dive look into it, whoops, I'm not logged in. I just hate companies that do stupid things like that. Let me log in and get back in. And show you that. I'm sure I could and say, yeah, okay, I like it for the volatility, but I generally tend to like things not to be too bumpy. I like my returns without the crazy risk that often ends up coming with high volatile companies like Tesla and Alibaba. So I tend to look at that. And why? Well, because you, even more than me, are going to get spooked and worried if that happens. If you end up getting in a situation, I can't access it, forgotten the password as ever with these stupid things. Yeah, that's basically the thing we'd be looking at is, okay, give us a bit of something low volatility. Now, when you look at these kinds of headlines and you might say, oh my God, Datadog's up 14%. The fact of the matter is you're probably not, if you're sensible, going to have it anywhere less than or more than 2.5% to 5% in your portfolio of any individual one stock. Otherwise, you're going to be overweight and you're going to be taking on too much stock-specific risk. That being the case, the fact that it's up 14% means barely makes too much of a difference. You might say, well, no, you're right, Alpesh, we should have 50% of our money in it. Well, can you see the problem with that? So generally, you shouldn't be getting excited anyway about any of this stuff. And therefore, you shouldn't be in the mood for, oh, I need a good stock tip. I need a good stock pick. Okay? Because you don't. Because when you look at the news on it all, you quickly come to the conclusion that actually, I'm not going to own too much of it. Okay? And when we look at all of this news, We're not seeing anything which is making us incredibly sad or excited or either way. Do we have Taiwan Semiconductor? Yes. Do we see negative stories all the time? Do we see positive stories all the time? Do we care about the stories? No. Because we've got value, growth, income, cash flow. We've got under 5% in our portfolio. So what more is there to be done? We can be calm. Are we going for momentum? Well, think of the scientific approach. And this year it's going to happen a lot where you're going to get big fallers and you're going to come back and you say, oh my God, monolithic, which I haven't done, has dropped 5%. Should I buy into it? Well, here's the other thing. You should have the kind of companies which you want to buy more of because they're high quality when they drop, but drop by how much? If they drop by 1%, well, clearly not. You'll be overexposed. If they drop by 20%? Well, no, not if it's a Meta, because that can drop 75% and you'll be overexposed and it's only dropped 20%. Microsoft dropping 25%? Yes. So how do you know what the number is for buy the dip on a quality company? Well, you can look at its historic performances on a chart and see what that number is. And as I say, for Microsoft, it's a 25% drop you want to buy more of. Apple, same. NVIDIA, 35, 40, 45% before you'd want to. Certainly not a 1% drop, not a 2, not a 3, not a 5, because you'll be overexposed. If you want to buy more and you're not getting overexposed. On the whole, I want to have 2.5 to 5%. So it's diversified across names. Okay. We'll talk about international stocks in a moment because you're thinking, oh no, but these are listed in America. Therefore they must be American companies. No, they're global companies. Microsoft's got a multi-billion. Microsoft has got more investment in Britain than pretty much every single British listed company. So don't tell me it's not British and it's only American. This whole notion that listing means that it must be purely internal. That's because most people, IFAs, stockbrokers, wealth managers, were educated on textbooks published in the 1960s when the world was insular. Now it's not like that. So you're having to unlearn a lot of rubbish that, must have different sectors. All sectors and countries are highly intercorrelated, especially when the markets fall. Okay. What we're essentially trying to therefore get to is something like this, which is what does the portfolio of 20 companies then look like? 20 to 40. More than 40, you've got too little money in any company, so it's pointless. Less than 20, you've probably got too much single stock exposure. Very simple. Now, what's the most important thing when you look at something like this? For me, it's not the return because the past returns are not guaranteed in the future. We halve the returns and say, if we only got 15% per annum, how quickly could we double our money? 5 years is the answer. If we got 32% per annum, because that's how historically it did, and if it continues doing that, of which there's no guarantee, we should double it in 2.5 years. So 1 million becomes 2 million in 2.5 years. In 5 years becomes 4. In 7.5 becomes 8, and in 10 becomes 16. But that's not guaranteed and is highly unlikely to continue just because of the nature of Sod's law. But we halve it. Now, halving it would mean worst case scenario, stock market last 15-year average return, 15% per annum. But the figure that I'm really interested in is the drawdown number. Can I take that drawdown? What does that drawdown of 17% mean? Let's say the drawdown is 20%. That means 100 grand could go as low as 80,000. Now, it could go lower, but probably unlikely to because historically over the last 13 years, it hasn't. But it might do. Okay, so you say to yourself, am I comfortable with that? Now, individual stocks within that might drop significantly more. Okay, I'll give you an example. What causes panic? So in the top row are the stocks which were in that portfolio. Okay, and I've pixelated out the names. Now, look at this. In 1 year, one of them went down 54%. 54 bloody percent in a year. Okay, can you imagine the boredom and panic? And yet that's a portfolio which has generated 32.3%. So the point is people don't think portfolio level, and nobody ever shows them the transparent. So we created this for Joe, we created this model portfolio for him. And we had to make sure, are you okay that should you be asleep at the wheel and not going to cash in 2022 like we did? Are you okay with those falls, given that you're still getting good returns historically, which isn't guaranteed in the future? And he said, yeah, that's okay. I can live with that. And look at the number of red years. Okay. We actually break that down stock by stock, month by month, so somebody gets comfortable. And the most comfortable thing the thing you have to get the most comfortable with, as Warren Buffett has said time and again, is the fact that individual stocks in a good portfolio can drop 50%. He said it, not me. The world's cleverest, best investor couldn't even avoid that as well. Okay. Raj, I'll show the one for Microsoft. I don't think you mean histogram. I think you mean bell curve, I think. Don't worry, I know what you mean. Now, let me show you something. Okay, we're going to go on with that. I'm going to come back to this. This is what we happen to have done on one of our portfolios, the January to December one. It's a filtered list. Okay, why January to December? Well, it's a calendar year. People like calendar years. Okay, the filtered list over the last 12 months. Now, you've got to be really, really clear about this. Did we know these stocks were going to go up by this much? No. Because if we knew HOCTF was going to go up in 12 months, 161%, we would have put all our money in there. That's why we have more than one stock. It's obvious. Anybody telling you otherwise is lying. If someone says, yeah, I'm so clever, I knew it would go up, Filtronic would go up 142%. You know they're lying, because if they thought that, they'd only put their money in that and nothing else. It's a very easy way to tell they're telling the truth or not. And I tell people time and again, I didn't know that was the one that was going to. I knew it was in our filtered list, i.e. we filtered it by value growth income over the last 12 months. Now, you might say, well, bloody hell, if you're getting 58% per annum, well, let me stop you right there. No, we're not. There was a tailwind last year in the markets. The whole tide rose. So we did better. But in 2022, we got zero because the markets were falling and we had to hold cash. We can't create and invent companies which don't exist if they don't exist. Okay? These are some of the others. I didn't know any one of these was going to do so well. I didn't know Ralph Lauren last year was going to do better than my NVIDIA holding. And anybody who told you that they would put their money on Ralph Lauren, not NVIDIA, is lying. Is lying. And yet Ralph Lauren did better. The point being, it ticked our boxes, but once it ticks our boxes, we don't know any more than that. We don't know it's going to be triple digit, double digit, or might not even rise. All we know is it ticks all the boxes and should do well as a portfolio. That's all. But private investors make the mistake of trying to read too much into it, particularly in this kind of market. So when we look at, I'll come back to all our individual portfolios, but for now, I just want to show you something here. That's the S&P 500. Where are we? Now, if you look at this, the green line there, I just want you to look at the green dotted line. It's just an example of moving average, the average price in the short and long term. Okay. That's all it is. The short and long term average price. Now, if you do some pattern recognition, you can see we are in a similar position to we were over here. That isn't guaranteed that we're going to drop. And by the way, peak to trough, that drop was 21%. It isn't guaranteed it's going to happen. Okay. It's not guaranteed it's going to happen any more than it was guaranteed that it's also similar to 2022 and their peak to trough of 27%. But, okay, what might happen? Well, if we did get that this year, then it would look like this. All right. Which wouldn't look unusual. Might not take a month. It might take 4 or 5 months. Okay. If we got a 14% drop, it would be like this. Right? Which, well, there you go. It's not particularly surprising. And last year, everyone all they remember is what a great year it was. So what I'm saying is, don't be surprised if you get the falls. It doesn't mean the economy is bad. It doesn't mean you should panic. It's fine. Don't panic. Okay. But I fully expect them to happen this year. I want to dive a bit deeper into those aspects of the market this year. And again, some of the stocks. Now, look, you already know it's in the public domain, so I'm not revealing any secrets when I say, yes, I do own Meta, Microsoft, Apple, Amazon, Alphabet, NVIDIA, JP Morgan, Goldman Sachs. But the point, and quite a few others, the point is, the key thing for me this year, it's going to be a very easy year because I don't have to do anything. I'm going to be doing nothing. Put on weight, got a Peloton I need to get on. So I've already explained what the macro backdrop is. Interest rates, okay? You don't have to do anything. Is there a productivity shift? Yeah, those AI companies are profitable. When I was doing my Bloomberg TV show, one of the key critical factors that we looked at during the dot-com era was the fact that nothing was profitable. So we knew at some point there's going to be a fall-off. It's all trading on momentum. If you get the videos from back then, I always said that. I said it's trading on momentum. There's nothing wrong with getting on a bandwagon as long as you jump off that momentum bandwagon before it falls off a cliff. And you had ample time to do it because it didn't. One day wasn't at 100 and the next day at 50. It's sort of went by, and that's why people like me survived the dot-com bubble. But at the moment, we've got profitability. As long as you've got profitability, you're okay. Bubbles and market crashes can only be caused by three things, okay? The P&L account, the balance sheet account, or the cash flow statement. Cash flow crises are like COVID, no more cash coming in, your shop's closed, causes the market to drop. Balance sheets ones are like the financial crisis, your house isn't worth what we thought, balance sheet crisis, asset prices, okay? And the most common one, the P&L crash, is .com. You ain't got any profits, mate. Pull you back. So history favors bull in the fourth year. There you go. There it is. There's all the data for you. You might want to take a picture of some of that as well. Okay, let me know in the comment section if you're finding this useful and the diagrams and the things that we're showing. I hope you are. Now, the Fed's pivot removes the primary bear case. Okay, the Fed is basically saying, look, there it is in an image. I've summed it up. Don't even need me to say it. I want you to read that whilst I just quickly have some more protein. How good is that? Okay. Fiscal stimulus, deregulation, all of these things you don't need to worry about. The investment bankers are worrying. I'm keeping an eye out for it for you. But I simplify it into very simple terms, which is interest rates ain't rising. Market's good. How good is it? I don't know. Which stock's going to be my best performer in my portfolio? I don't know, because I was really surprised over the last 12 months. Microsoft's been 0%. Luckily, it's not the only stock I have. But JP Morgan delivered, Alphabet delivered me 60% and JP Morgan 50%, and so did Goldman Sachs. That's nuts, because I would have thought Microsoft would have delivered me more. But it's not for me to second guess. It's fine. That's why you have a portfolio and not just one company. AI is moving from hype to broad economic productivity. And that's the case. The investment banks are saying it, and it's their job to look. Obviously, the companies are saying it. The only people not saying it are the people who want to sell you a newsletter and cause you panic. And I can bet you bottom dollar, somebody like St. James's Place is not going to give you the returns out of these, because what they'll do is they'll put 0.01% of your money in one fund, and then say, yeah, but they're a bit risky, those, and then shove everything else into boring rubbish and give you 5% per annum. Okay, so be careful of those muppets. It's a warning sign. Valuations, are they being kept in check? Are things getting carried away? Well, they're not getting carried away, because what we're seeing is that the skepticism, which is good, the skepticism, the AI bubble debate, the contrarian insight, all the things that people say, oh, this is too good to be true. That means that we're not going too quickly upwards, which could lead to bubbles. Okay. That's why it's going at a Goldilocks pace, not too quickly, not too slowly. It's like putting water through a pipe. Do it too much, it goes everywhere. Do it too slowly, it dribbles. And that's what's happening. So every time I hear somebody having an AI bubble debate, I'm glad, because it means it just makes sure we don't get carried away with ourselves, which could cause a bubble and cause a crash for everybody. Okay, ruin it for everyone. Okay, so the midterm elections, the market volatility is going to happen. Morgan Stanley think that the entry points, there will be some lows because of market volatility, and there'll be good lows, but they still think the long-term bull trend is in place. So do Goldman Sachs, and so do JP Morgan Private Bank. And if you've not come across it yet, then if you do go on my LinkedIn, which is on alpeshpatel.com, there's a LinkedIn thing, then what you'll find is some of that research I've put on in those places as well. So there'll be some detailed research on that, and on my blog, which is also on alpeshpatel.com as well. You'll see it, quite detailed research that I share with people on there as well. He says when he finds it, and the web doesn't freeze, okay? The internet doesn't freeze. So these, which are sort of going around in circles, they'll be detailed PDFs. And I've uploaded quite a few of those, and they're also on the blog. So if you go into the blog, you'll see a whole load of PDFs on investing that I've put together. And they're really useful. Okay, so do have a look at those. I don't know why the website's so incredibly slow. Well, it's not my website, it's LinkedIn, which is owned by Microsoft. It's so incredibly slow. Now, case for global diversification. Well, you could go into Europe just because, but how much? Look, it's really simple. Your decision-making process to stop confusion is really simple. If you go into Japan, you're going to treat it as one security. You're going to buy the Japan Exchange Traded Fund. You're going to have 5% in it. Europe, you're probably going to have 5% in a few companies or the bank stocks or the stock 600. Okay, 5% ETF. Bitcoin, 5% ETF. Gold, 5%. And you're going to hold it for a longer term. That's it. Job done. Move on. Next slide. Stop poring over it. Work out what the limits and constraints of your decision are. And that simplifies what you have to worry about. It's a bit like me going to Harrods and saying, well, I've only got £100 to spend. So why do I need to worry about what's on every single bloody floor, which costs millions? I don't. Right? And we do the same with the market. Well, Japan, am I in or am I out? Good diversifier. Am I in? Longer term, okay, I don't mind holding it. Or, yeah, I do object to holding it. What's the point? 5%, boom, in, gone, moved on. Gold, am I in or not? Is it going to go up or down? Don't know. Am I in for the long term? Yeah. Okay. If I'm in, it's 5%. Job done. Weaker dollar? Well, okay, it favors emerging markets. The dollar will move up and down, up and down. I'm not so bothered about that angle of it. And I'll tell you what my major problem with emerging markets is. And I'm going to show you because I get people saying, oh, what about this one? For argument's sake. So I'm going to show you the example of India from where I've just come back. And, okay, I'll show you the India ETF. Okay, so there you go. That's the India ETF. Now you might say, well, that looks fantastic. Look at that, Alpesh. It's gone up and up and up. Well, let's run some numbers on this, shall we? First of all, if the monthly MACD like this is falling, I never want to be in. If it's rising, I'm in. If it's falling, I'm out. Very simple rule. Okay, I've just given you a very simple investing strategy with country exchange traded funds. If the monthly MACD blue line is rising, you're in. If it's falling, you're out. Okay, it's a very simple rule. Sometimes you might get whipsawed like here. That's the price you pay. And you've got to spend a lot of time looking at it. If you're going to use that rule, that's the price you pay. So let's look at this, the golden period here. Okay. And what happened there is you had 36% return, right? Went up 36% from 2023 October to 2024. So in a year, it went up 36%. That's the golden return you're looking for. Okay. And it's happened before. The only way you're going to get that, and people say, well, what about India? I'm going to get some coverage out of India. Yeah, is if you've got this scenario happening again, i.e. that blue line needs to fall a bit more and it needs to rise. That's that. And then your bull case, bull, base, bear. Your bullish case is you get 36% in a year. Your base case is you get 0% in a year and it lets you down. And your bear case is you lose, like there, maybe 11 to 15%. So overall, yeah. But how much are you going to put in? 5%. Are you in or are you out? If you're in, then you're in 5%. That's it. Simple. Job done. Then you can move. And if you're only in 5%, you're not going to break up in a cold sweat about it. The only time you're going to break up in a cold sweat is if you start gambling. What's the definition of gambling? Too much money in one individual security, such that you have to hope that it will go in the direction you need it to go in. Well, we're not gambling. So yeah, okay. Let's say I don't have any India, but let's say I had some India. What do I care if it's gone up? Just like I've got gold. Why have I got physical gold? Because I'm Indian, born with it. Well, am I excited it's gone up so much? Well, not really, because I'm not planning to sell it. Haven't done in 54 years, so probably not going to now. Oh, okay. And I didn't have more than 5% of my net worth in it. So do you see how somebody like Warren Buffett lives to 95? Because he doesn't go, whoa, yay, made loads of money. I'm the world's richest man. Let me go buy a private island. Okay, it's just, great. We're making returns. It's a machine. It's a money-making factory. A portfolio is a money-making factory in which the people you've hired are the company's management boards whose job it is to solve the problems of the world and deliver profits to you, the shareholder. 2026 investment playbook. And that can happen through US, UK companies. So what's the playbook? Okay, for me, look beyond max. Well, I mean, I don't just have 7 stocks in my portfolio I've never had. Okay, so that had always been the case. I've done that playbook before now. Okay, tactical approach. Tactical means trading. Healthy correlation is going to happen. For me, the tactical approach will be If Microsoft drops 25%, 30%, I'd buy more. If Nvidia drops 40, I'll buy more. Bitcoin, if it drops below 40, I'll buy more. For Microsoft, somebody asked me, what are the numbers? Well, I'll tell you what the numbers for Microsoft are on its drops. Okay, really, oops. Oh, that's weird. Here we go. Okay, really simple. There's your Microsoft numbers. Okay, there's your Microsoft numbers. Microsoft, typically, if it drops 20%, 23%, it tends to not drop more. So it's a buy. What's the buy to dip number for Microsoft? It's 23. But you can only do that with quality companies. You can't do that with any old crap. Okay, so you might say, well, is Meta a quality company? Yes, it is, except Meta's number is closer to 75%. You don't need that to find it. You can just look at it on the websites, and you can just say, oh, okay, what's Microsoft's, no, what's Meta's number? Let's have a look at Meta. Okay, we know it's 75% because when you put the bloody damn thing in, look at that. We know it can have that's not by the dip. Well, there's another clue to it, which is you never want to be with those companies when it's what's called a daddy bear, when the green's falling below the blue, because that means both the medium and short-term prices are falling. In other words, the short-term money and the long-term money are both selling. Okay, and if they're both selling, you're screwed because you've got nobody to temper things down. It's as simple as that as well. Okay, so stay invested. The cycle has room to run. Don't panic at all. That's going to be key. My approach, this is a complicated image, but I'm going to show you my approach. Okay, the approach, as you know, right, from that is we take those 10,000 companies, we filter for value, growth, income, cash flow. We look at it at the portfolio level. The foundation of it is transparency. We should be able to see why we've got those companies in our portfolio. Okay. Most portfolios fail due to investor behavior. Yeah, panic. They panic or they get bored. That is the problem. If you start getting a few of these things right, then guess what? You suddenly discovered, oh God, it's not about the next hot tip. It's about the process. And if the process is correct, it's a machine. That's your factory for making money. That's my factory for making money. Okay, that's what my factory dashboard looks like, right? And most of my clients say, can you just make us a model for us? And we'll pick the model. And they might tweak it slightly and we make it a bit more bespoke, but it's going to be about 20 to 40 stocks. And that's a lot simpler because guess what? Like Warren Buffett, we end up doing nothing every day other than watch the sound of screaming headlines going past our heads. And that's how it should be. It should be like that. It shouldn't be just all panic driven. Sean, between 20 to 40 stocks in a typical portfolio I'll have. Okay, so between 5% to 2.5% in each. And depending on age and risk appetite, you could have lower volatility stocks so that you get a lower drawdown portfolio and you could hold more cash, like 10% in cash, 20%, a year's worth of expenditure in cash, 2 years, 3 years, 5 years. If you're about to retire next year, you don't want any stocks because you're about to bloody retire, for argument's sake, and you want the certainty. But if you're in your 40s, 30s, 50s, you have 5% in each, you let it grow and compound. And if you get a tailwind, as we've had over the last few years, and long may it last, then you get 30%. And if you don't get a tailwind, you get the market average, you get 15%, which means double your money in 5 years. Okay, at 15%. That's what it means. These are just some of the client portfolios. We put the portfolios together. Now, I'll give you an example. If you look at, say, just Meta, Microsoft, Apple, Amazon as a comparison, that's what it does. If you look at the S&P as a comparison, and that's the 2 times leverage version, that's what it does. If you look at the FTSE All-Share, UK All-Share, that's what it does. So it's just giving you some examples. And then if you look at our versions, that's what they do. And why are they different? Well, because each client has different risk appetites. Some are very high risk and they don't mind taking higher risk, or they've got the certain stocks that they want. Others will say, no, I really want the lowest possible drawdown and volatility. Okay. These were the LSE top 25 stocks, sorry, the top 20 stocks last year by performance. Okay. You're not going to get those. We didn't get those because some of them might go up because of random chance. Those are the US equivalent. Okay. And you know, how do we do it? How do we do it? only a private investor is trying to gamble on that. Only a newsletter seller is trying to gamble on that. Warren Buffett didn't own any of those and became the world's richest man. So there's certain things I want you to know. Now, maybe there were keywords. If you had rare earths in the title, or oncology, or pharmaceuticals, or biopharma, but I can show you a whole bunch which have dropped 99% as well. These top stocks are not the ones you're trying to get. They make a hero out of you, but people are lying. And I could gamble and throw darts at these. Okay. These are some of the best performing exchange traded funds, and they were largely gold. But so what? How does that help me? If I'm not trading gold, then I must be investing in gold. If I'm investing in gold, then I could only have 5% of my portfolio in it for the long term. So it removes all the excitement. And if I'm trading in gold, why am I trading? Why am I speculating? And if I'm speculating, on what hypothesis, what basis am I gambling? Private investors love to gamble. That's why there is a Ladbrokes on every single high street, and it's why they stay poor, because they love gambling. Okay, and they're overconfident in their abilities. If you invest monthly, how do you split between 40 to 60 stocks? Well, what you could do, what do you think the answer is? Logically, the answer is either you're going to put equal amounts into each, in which case you'd have 40 individual transactions, which would be somewhat inefficient, and you'd only do it if you've got a very large sum of money, or you will build up your portfolio gradually until you've got your 40 each month. Maybe one month, because you've got such small amounts, you buy one of your stocks, then the next month, another one. There's only two logical answers to it. That's how you do it. Science meets serenity, the bespoke investment model. So this is how we think it ought to be done. We think Goldman Sachs Wealth Management said companies in the top quartile by cash return on capital invested deliver 30% per annum. We believe if you take Nobel Prize winning research, where it says look at valuations, revenue growth, dividend yields, and cash flow, then you will come up with companies in a portfolio which won't all go up. Some will go up more than others, but will avoid the problems. If you then know from the literature that pain of loss is twice as painful as the joy of gain, then you know to leave the portfolio alone and not panic or get bored. You also know, well, what's the security? Well, once every 5 to 7 years, you need to be in cash. The daddy bear that I talk about, that's the S&P 500 we'd look at. So we keep a daily eye on it, but only once in 7 years does a ship come close enough to the lighthouse that we think will hold cash. And the last time it happened was 2022. What if I fall under a bus? Don't worry, we've got a whole team behind me. And we always tested under 2022 where the markets fell, as you saw, what was it, 25, 27%? And does the portfolio still generate 30% per annum despite falling 27% in the markets in 2022? If we can survive those elements, we're still not guaranteed anything. But the goal is turn 200 into 400, 400 into 800, 800 to 1.6 million. That's what 15% per annum does. And that's half of what we target. We set a very high standard with the companies so we can achieve more by them as well. So that's what we do. That's how it's done. Then when we make a model portfolio, i.e. we make a cake for students, or some students make it themselves and then we test the numbers for them. The other thing I'm going to say to you is have a look at my YouTube channel as well. I just want to show you the sectors because I realized I forgot to show you the sectors, the US sectors earlier. Here are the US sectors and how they're doing year to date. Now, again, another warning of how people are going to mess it up this year. It's going to be a really easy year, this. It's a year of buying and holding quality companies and not doing anything. But most people are going to panic. They're going to chase headlines. They're going to chase momentum. They're going to say, oh, energy is doing really well so far this year, so I must stay in energy and nothing else. It is doing rather well, and it might continue doing rather well. Okay, but chasing sectors, unless you've tested that hypothesis that the sector which has done the best over the first 3 months is likely to do best for the remaining 9 months, or you've tested the hypothesis that your understanding of narratives tends to allow you to be outperforming in the stock market. If you've not tested either narrative scientifically by looking at the data, then you're gambling. And feel free to gamble, but I don't want to gamble. Thanks very much. World equity indices so far this year. Well, why have I got exposure to NASDAQ and S&P and all the rest of it? Why not Singapore Straits Times or Hong Kong Hang Seng or the Australian? I could do anything. There's so many permutations. So the other problem you're going to have this year is stop having FOMO, the fear of bloody missing out on something. It's, again, a retail client disease, which leads to gambling behavior. And the more they gamble, the more they lose money. Whereas people like Warren Buffett and myself sit back and just let the bloody market delivers a return, which is not the hypothetical best possible return we could have had. It's just not. Okay. And I showed you with the S&P. It is similar to the levels it's been previously. It's not guaranteed to fall, but if it does drop 14%, and if a Microsoft drops far enough, I might buy more. But otherwise, most of my job this year is to do absolutely bloody nothing other than these webinars. Okay, that's where we are. The global economy in terms of GDP is looking really good. The US at 4.4% growth. Do you understand just how massive a growth level that is? So Donald Trump, because of the media, has been discounted as a complete lunatic. But I'm sorry, 4.4% quarter-on-quarter growth is phenomenal for a country that size. It's phenomenal for my stocks. It's going to make me rich. Trump's making me bloody rich. And his tariffs and increasing tax through tariffs has meant he's kept inflation, because it's a tax take, kept inflation because people see tariffs as something imposed on other people, not on themselves. If he said it's a tax on you and people believed it, then they'd be pissed off. And it is a tax on them. But he's just reframed it, recommunicated it differently. It is Nobel Prize winning because his economy is growing 4.4%. Will there be a price to pay eventually? Of course there will. Will there be a price to pay for some of the wrongs that they're doing socially, politically? Hell yeah. Of course there will. But I'm just talking the markets are immoral, you might even say. But Japan 1.2%, and the other countries don't really matter because they're too bloody small. Who cares? Okay, on that. So that's where we are with those things. By the way, the other thing is IPOs make a lot of noise. Like Warren Buffett, I don't invest in IPOs. So whilst I see, oh my God, tech create has gone up 100% in a day. Yeah, but we don't have a strategy that we've tested on that. Paresh does. He did the strategies for a hedge fund, and they did have IPO strategies, but that's a separate thing. That's more trading. So does it mean that I've got FOMO, that I'm missing out on some of these? Yeah, but if I can't create think of me like a scientist. If I can't create a hypothesis that I can test with it, then that's not a field of science I can do. And the field of IPO science is not for me. The field of portfolios, which generate good returns over a prolonged period of time, is my area, of scientific endeavor. And that's what I stick with. Okay. Any other questions? Is it a buy the dip opportunity for software stocks? Well, it depends on which specific ones. As I've already highlighted, Microsoft might drop 20% and it's worth buying, and something else might not. So it depends on the companies, and the way you decide is first of all, does it meet the value growth income criteria? If not, it's not a quality company anyway, so you better stay clear. And if it does meet that first hurdle, then the next question is, historically, how much has it fallen before it's rebounded? And there's your number. So it's not a generic question. Is it a buy the dip on a Tuesday morning in London? Tuesday afternoon. The question is, what's the specific stock, and does it meet the quality criteria? And it's that thoroughness and the discipline of knowing that's more important. But people do have a tendency to just ask generic questions, and then obviously they mess up their portfolios because they go, oh yeah, Alpesh said it's time to buy the dip on these. Well, no, I wouldn't ever say that, because it depends on the quality company, and it depends on the amount it's dropped and whether historically it's rebounded from it. And when you hear that answer, you think, oh yeah, shit, that's obvious, isn't it? Yeah, it is, to somebody who's experienced. Okay, you sold 2 times S&P and NASDAQ. Yeah. I haven't done a broadcast for a while, have I? Yeah, because the MACD is not falling. The monthly MACD is not falling. It's not Mama Bear. So yeah. But for all I know, today's the peak of the market. And tomorrow I might be out. So just so you know, tomorrow I might be out. Well, I won't be calling you up and saying, hey, mate, I'm out. You're going to miss it. So if you're trying to be a trader, you better have your own hypothesis. And your hypothesis better not be, oh, my hypothesis is if I happen to catch an Alpesh Patel webinar, then I hopefully will work out with my money. Oh, shit. Oh, God. Okay. So that's where we are with that. Okay, guys, it's coming up to 1600 on the dot. So I'm going to leave you with some goodies. The goodies on this webinar are, there's some files I'm going to leave you, and I'm also going to remind you these amazing pension tools, which are all free. You don't even need to give your email address. Okay, they're all free. And they're really, 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 really good, okay, to work out with your pension, how much you should have, how much you should save, and it'll run stress tests on it, and they're all completely free. So do watch out for those. For anybody who wants to be part of the program, if you're not already, then please do feel free. If you don't know what the program is, let me know, because it'd be good to know how many people don't necessarily know what the program is. So there's that element as well. And I'm going to send some files across to you now. Okay, they should be coming through, including a copy of the book. Okay, which you're going to have. So there's a whole bunch of files you should be getting. Why poor fund managers exist as well. You're going to receive on there. Okay. So thank you all very much. If any of you'd be interested in the program, let me know. You can know more about the program at alpeshpatel.com/shares. There you go. So do have a look at that. And you can see our past performances on things as well on there. Thank you all very much. Thanks, Daniel. No, that's very good as well. Okay, so that's very good. It's not a good hypothesis. Okay, so any other questions, let me know. If there's anything else you need, you can email me as well, but I do want to try and keep it within the hour for your sake and mine. So I want to thank you all for being on here, and I hope you found it incredibly useful. alpeshpatel.com/shares, as I said, is the place to go for more on there. And I've also posted some free articles on there as well, which you'll be able to access. If you go to this bit up here, you'll be able to see, you can see some of the return reports and so on for last year, and also some of the stuff for 2026 you'll be able to see for free without having to register on there as well. So thank you all very much, and I hope to do more of these as well. Thank you. Thanks, everyone. Okay.